And these people are you. You continually help us by referring us your friends, your family, your business partners, and just being great clients. And so we want to. This is where we want to thank you for coming tonight and for helping us. So thank you. Also want to thank our team. Our team is crucial to what we do to hopefully make you happy. April and Cheryl, everybody, they're here tonight. Stand up for a second. Yeah. April and Cheryl, the backbone of us getting things done for you. So we want to thank you for coming and being here tonight. So we also have Grant, who is also new to us in our operations. There he is. Grant, stand up. And Grant's learning from the best, and he's getting it done. So appreciate you. So we have a new person in our office this year in operations, Mark Muller. Mark, are you there? Yeah. Mark was retired for about a day, and I talked him into coming back and helping us. He is our director of operations, and he's helping us run the business. He gives us freedom to do what we do best, and that's hopefully, you know, working with you, our clients, and he's running the business for us to take a lot of that stress off of us. So thank you, Mark. We have Matt McGee. Matt. So Matt is new with us, and he's our director of financial planning. We recruited him to come work with us about 3 months ago, and we're just thrilled about what he's bringing to us already to help you reach your goals and just making us better. So thanks, Matt. DJ and Connor, where are you guys? Oh, there's DJ and there's Connor. Yeah, these guys are new advisors to the business. Taking their tests, they've already completed it. They're learning left and right. I mean, as you can tell, it's new blood in the firm, right? Great new ideas and thoughts, and we're just thrilled to have them. Thank you, guys. So next, we would have Lindsay, who is in our Hot Springs Village office. You can't see her. She's the backbone of that operations for us. We will have Joanna and Jonathan. Joanna is in our Hot Springs Village office. Jonathan runs our Dallas office. These two are seasoned advisors and partners with me, and they just help us grow the business and just keep it running smoothly. So appreciate it. You know, last but certainly not least is my partner, business partner and life partner, Lori. Where are you, Lori? Yeah. Yeah. Lori is the it in our business, that in our life, that in our family, that keeps us strong, both family and business. So, thank you. Okay. So we're building, as you can tell, we're building a firm that is going to outlast me. You know, I get that question these days. I don't know why. I think I'm still 40, but you know, we have advisors now in 5 generations. We have the 20s, we have the 30s, we have the 40s, we have the 50s, and now 60. And so I'm thrilled about where this is heading, and hopefully you guys are seeing that too, and you'll see more of it. We have a ton of new ideas and alliances coming that'll be announced this year. I'm excited about 2025. I'm having fun in the business again and just loving working with all of you. One of those alliances that we have built over the years is Marianne Bartels. And Marianne, you know, I've been working around and with her ideas and research for the last 25 plus years. Many of you have benefited for 25 plus years of Marianne's thoughts and leadership. Marianne has literally had an award-winning year in 2024. I mean, literally award-winning year. She had in our industry, in every industry, you get different awards, right? But the Wealthies is a industry award. The business. Wealthmanagement.com is an industry award. And so the Wealthies, she had Thought Leadership Award on Wall Street. Then she had, on the wealth business, she had Oracle of Wall Street, which is most accurate predictions of, I think there's 10 or so, right? So really, I'm not giving it justice, but she just had an amazing year. And so this year, after this is over, this will be her third rodeo, straight rodeo with us. And I think we all can, call her our own hometown cowgirl from now on. So without further ado, Mary Ann.
Listen to the song. The young people might know it. Know Harry Styles? Remember Harry Styles? This song is called Golden. Okay, we can go down. Thank you, that was perfect. I'll start dancing. When I did my year ahead for our strategic partners like Brad and mFORCE, I try to come up with a theme. This is my year ahead theme, which I will talk about. But when I did my year ahead, I try to come up with a theme. And I always ask for divine guidance, and I never know when it's going to come. If you can believe it, I was at the O Spa Hotel in West Palm Beach, in the spa, and it hits me. It's the golden age of investing. That's your theme, Mary Ann. Then, because I like to shop, I'm looking at stuff, and I see this dress that's handmade in Brazil. It's black with all this beautiful gold on it. That was my outfit that I wore. And I had no idea Donald Trump would say it's the golden age of America. So I've put them together. It's the golden age for investing in America. It's not that hard, and I really do believe that. I really believe that we're in a time of history that's absolutely beautiful, and that we're blessed to be here when we're transforming into this whole new digital world, and the innovation that's coming is so exciting. Now, for some of us older folks, it may not be exciting, because I know every time things change on my phone, I get frustrated. There's this thing called digital currency, and it's called Bitcoin on the blockchain, and I can't see it, and I can't touch it, but all the kids think it's great. So it reminds me of my mom when credit cards came around. She didn't like them, and my mom refused to use a credit card. There's a lot of new technology that comes around, and when it comes around, if you didn't grow up with it, it's foreign, so it's not comfortable with you. So when I was writing my year ahead and doing my research, many of us on Wall Street are comparing this innovation period with artificial intelligence and blockchain and robotics with what happened in the 1990s with computers and with the internet. And there are similarities. But there's another time in history that we went through, except none of us remember it. It's called the 1920s. It was huge. So this is a cover. I'm very proud of this. If you don't like it, don't tell me. I'll be very upset. But I wanted to show that we've had innovation going all the way back to the 20s. There was a time we had horse and buggy before we had a car. In the 20s, we invented cars, right? We invented electricity. We invented the radio. Could you imagine if you are an older person and a voice comes out of a box? I am sure some people said it was the devil, right? Really, seriously, think about this. New technology can be scary if you didn't grow up with it. I grew up with telephones and TV as technology, right? Most of us did. We didn't grow up with, we're not digital people. Charlie Chaplin, right? The master of silent films when voice came around. He didn't want voice in his films at all. It took him a long time to embrace voice, right? We're in another pivotal moment of great innovation that's coming to us. So I looked back and I said, well, what happens when we have this innovation, right? Because that's why we're all here. What's going to happen to the economy? What's going to happen to our portfolio? So that's what I'm going to talk about, because we have all this new innovation of the internet. NVIDIA's created the chip called the Blackwell, Without that chip, we don't have AI. NVIDIA is actually the creator of AI. We can't have it. We have smartphones. And I tell this to people all the time. If you want to know the new technology, just watch Star Trek. Right? Kirk had a flip phone. Aurora had a thing in her earpiece. Nowadays, every young person is walking around with something in their ear talking. Sometimes I think they're talking to me, and they're not. They're talking to themselves, really, but on that earpiece. Think about the consoles in Star Trek Next Generation. They're like iPads, holograms. So you know they have the technology today. If you walk in and they take images of you and listen to your sound, they can now create a digital you that is hard to tell the difference between the real you and the fake you. Right? What does that remind you of? Holograms. If they can create imagery that feels real, that's a hologram. Bitcoin is just the currency. So this is a little bit more complicated. What's the currency on Star Trek? Most people don't know what it is. It's called Latinum because you don't see it very often. They don't do a lot of transactions. It's Latinum, it's a metal, it's not stable. They have to put it in gold. But they also have what's called credits. Pay attention. This is going to help you. We were talking about Bitcoin. He wants to learn about Bitcoin. So they have credits. Well, what's blockchain? Blockchain is a digital ledger of credits and debits. It's just on the internet. It has to be verified multiple times. Okay? Got you with me so far? What's Bitcoin? Bitcoin is a digital currency that trades on the blockchain. Credits. Bitcoin. Bitcoin can be credits. It's a currency. It's a digital currency. When we created the internet, we did not create a currency. Today, Bitcoin is that currency. Will it stay the currency? I don't know. But right now, it is the currency. When you hear other cryptos like Ethereum, Solana, Chainlink, there's a lot of them. That's not a currency, even though they're called cryptocurrencies. They're technology being built on the blockchain. This is the next generation of the internet. The internet was, originally when it came out, was only read. Think about when you had the internet and you had email. Could you tell the difference between the internet and email? You couldn't. Email seemed like the internet. But as we got different applications, we went to read, write. This next generation is read, write, own. We will digitize everything and put it on the blockchain. Stocks will be on the blockchain. Bonds will be on the blockchain. Your house will be on the blockchain. You won't have all this, hundreds of pages that you have to go through when you're buying and selling a house. It will all be done digitally on the blockchain. So I understand that new technology is very uncomfortable, but just because you're uncomfortable doesn't mean it's not going to happen. Now, you don't have to embrace it, and I can honestly tell you my disclaimer on all the cryptos, including blockchain, it's an asset class that is the most volatile of my entire career. Things go up and down like yo-yos, and they can go up and down 100% in a nanosecond. But millionaires have been created because of the crypto space. So let's compare. Let's look at the world. But I want you to go 50,000 feet up in the air. So I'm going to try to set the stage for you. In the 1500s, which none of us remember, what was the technology? And the answer's up there. The sundial. If you're agriculture, you're a farmer, right? Time of day is really important, right? So that was the sundial. Our economy didn't really start shifting and changing until we created the steam engine. It was a major transformation for our economy. So since I started in the 1500s, we were agriculture for 200 years. We become industrial, but then we go digital. I do 2000 because it's kind of easy, but it was really the 1990s. Well, we were industrial for 300 years. So how long do you think we're going to be digital? Well, probably what you care about is your lifetime. For your lifetime, it's going to be digital, but it's probably going to be for hundreds of years. So I want you to think about the 1700s to where we are today, how much change has happened? How much innovation has happened? Can you imagine where we're going to be in another 50 years? So the new technology, AI, ChatGPT, is now the fastest embraced technology of all time. It takes us a while to embrace various different pieces of technology, but every new piece of technology we create, we adopt it faster and faster and faster. Why? Because the young people embrace it. Because they're digital. Got it? It's easy, right? That's not hard. So these are just some charts showing you how fast it took to adopt automobiles, to adopt radios. This chart goes back to the 1920s. We had tremendous growth because of the innovations. So our economy grew. That is the pinkish line. And the S&P is the blue line. When you grow your economy, you grow corporate profits, stock prices go up. That's the one thing I loved about economics. It basically taught me how to think. How do you put the pieces of the puzzle together? Or how do you connect the dots? Wall Street is actually relatively easy if you understand the dots. Getting down to the nuances and trying to forecast where we're going becomes hard. But we know if we grow the economy, companies can increase their earnings. You increase the earnings, stock prices go up, right? That's not hard, right? Everybody got that, right? Okay. Now, let's look at the 1990s. Because of the innovation of the internet and computers, we grew the economy and we grew the stock market. The NASDAQ went up 1,000% from 1990 to 2000 because that's where all the internet stocks were. Now, did we have a bubble in the 1920s? We certainly did, right? Crash in 29 and we crashed in 2000. If my thesis of where we're going is correct, we're going to repeat this all over again. So here's my thesis. I think this year the markets can be up 20%. By the way, if you study history, the statistical probability of this year being up another 20% it's tiny, 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 tiny. So why am I so crazy to forecast this, right? Just because it very rarely happens doesn't mean you can't repeat it. When I went back and I studied 1995 to 2000, why 1995? Because that's when the markets really started to move. It wasn't 99 to 2000. The move started in 1995 and didn't peak until 2000. That's 5 years of return, where the market went up 20% every year. It's the only time in history that ever happened. But what people don't remember is we had two bear markets. Markets went down 20% in 97, and they went down 20% in 98. We had a Thai baht crisis in 97, and we had the Russia default, which caused a hedge fund to have a problem financially called long-term capital that impacted a number of important banks in this country. So we had to intervene. The Fed had to loosen up, lower interest rates. Then do you remember Y2K when the computers weren't supposed to turn on as soon as we went to January 1, 2000? I remember that because at Merrill Lynch, everybody had to be tasked. And I was on the first market opening, and that was Hong Kong. And we're all bracing for the markets not to work. And everything worked fine. I said, I stayed up for this? I thought, it was great that I was going to be on the front lines. Nothing happened. But the Fed had printed a lot of money prior to this in the anticipation or risk of something happening. So when you print liquidity and money, it eventually finds its way in the stock market. Got that part? Now, how much money have we printed this time? Well, we went to 0 interest rates. We did it in 08, 09. We did it in 2020 and 2021. That's extremely stimulative. When Bernanke took over the Federal Reserve before the financial crisis, the Fed's balance sheet was maybe $800 billion. So we'll round it up to $1 trillion. Where did that, where Powell's the chairman now, where did that go during COVID? Anybody know? $9 trillion. Yeah, exactly. Whew. Wow. Can I curse? That's a shitload of money. You're a bank. That's a shitload of money. For the first time in our history, when the yield curve inverted, so what's the inversion of the yield curve? So we look, for those that have no idea what a yield curve is, we take treasury bonds or treasury certificates and start at 0 and go all the way out to 30 years. And we look at the interest rates. The normal curve has, as you go out on the curve, are higher because you're taking more risk, and the rates on the shorter end are lower. But when the Fed wants to tighten things up, they flip it. And then rates at the short end are up here, and the long rates are down here. That's not good for banks, by the way. They have a hard time making money. It's good for you if you're in cash, right? The yields finally go up. But every time in history that's ever happened, guess what happened to the US economy? Went into a recession. So many were out there in 2022, 23 going, we're going to have a recession because the model says we're going to have a recession. It always happens 100% of the time. Did we have a recession? No. We did the complete opposite. We grew. No one thought that was possible. Actually, there's one person. His name is Ed Yardeni. He's one of the few people on Wall Street that forecasted we wouldn't have a recession. Another one might be Marianne Bartels. But, and why did I say we weren't? And I didn't even do fancy econometric models. And the worst thing, I don't like forecasting GDP. It's like being a weather forecaster. You can have all the information and you still get it wrong. It's the hardest thing in the world to forecast. But why was I encouraged? Because I just looked at GDP year to year. And then I looked at GDP year to year, year to year. It's called the second differential. If you know math, you'll understand what it means. If you don't understand, it's momentum. And I saw that GDP was bottoming. And I'm like, we're not going to go in a recession. Then I'm looking at corporate earnings. And I'm like, corporate earnings are starting to turn. How did I know that? Analysts started raising their estimates. I'm like, I don't think we're going into a recession. That's going to be great for the stock market. So I've been bullish the stock market. I had other indicators and stuff like that I looked at, but I won't bore you with that. We've printed all this money. And we're still, today, in cash, have $7 trillion. Money keeps piling up in cash. What I've learned and what my aunt taught me is that Wall Street's a pendulum. My aunt went to Wall Street in 1956, first woman to be on the trading floor at Ladenburg Thalmann. She didn't want to go to Wall Street. Her uncle got her a job. She felt obligated to do it. She thought she'd do it for a couple of years and find something else. And she created a phenomenal career on Wall Street and had her own business and her own newsletter. And she taught me a tremendous amount about the markets. I couldn't do what I'm doing today without her. She always told me Wall Street is like a pendulum. When it's bad, she says, Marianne, it's really bad. I mean, they cut deep. She says, but when things were working, she says, they become gluttonous. So I'm kind of looking at where we are. I think we're kind of right in the middle. We're in that little sweet spot. What's wrong with our economy? We're growing 2.5%, 3%. We're at full employment. Companies are making money. Stocks are at record all-time highs. Housing prices are going up. Household net worth is at a record high. Will you please tell me what's wrong with this picture? It's perfect. We should be celebrating. Oh, on top of that, the Fed decided to cut 100 basis points, 1%. Never happened in the history of this country where we cut interest rates 100% and everything was fine and dandy. By the way, that's stimulative. That adds to risk. That adds to liquidity. How can I be bearish? I can't be bearish. On top of that, I have this whole new thing called AI that we're going to build out. It's unbelievable. So I think we're at the sweet spot. At this table that I was sitting at, we were talking about Sir John Templeton. Brilliant man. He's not with us anymore. He was really the first investor that encouraged people to invest outside of the United States. And he came out of Franklin Templeton. Well, that's where the Franklin company bought Templeton, and they became Franklin Templeton. Sir John Templeton was a genius. When I started managing money internationally, I read his book, and that's what saved me, literally. But he had a great way of saying that, and I'm not going to get it exactly right. You can Google it. Markets bottom on fear. think about when markets bottomed in March of 2009. Were you all rushing to buy stocks? Or were you all worried about the banking system imploding? I would say 99.9% of the world was still concerned that we were going to implode. Great time to buy stocks. The time to buy the market is when it looks really bad. Then it rallies on skepticism. You're a skeptic, kind of not trusting it. I think we're kind of there. And then you kind of rally a little bit on optimism. We're trying to get there. I think we're kind of moving from there's still some skeptics and there's still some optimistic. So we're kind of in that little sweet spot. You don't peak in markets until you get euphoria. We're not even close. Not even close to euphoria. And you peak in markets when everybody's invested and the market is levered. Right? Everybody goes all in and leverages up. And I'm going to show not even close. Not even close. So I think, because we have secular markets, we have secular bears and secular bulls. They last 15 to 20 years. A secular bull market started in the S&P in 2013, and in NASDAQ it started in 2017. Doesn't mean you don't get a bear correction. Markets can still go down 20 or 30%, but you go up and you make new all-time highs, right? We had a bear market in 22. Markets went down 30 some odd percent. But we came back and now we're sitting at record all-time highs. We still might have one more bear market between now and the end of the decade. But I think by the time we get to 2029, 2030, we might see the S&P somewhere around 10,000 to 13,000. You want to miss that ride? I don't want to miss that ride. So that's where I think we're going. I think the long-term trend is definitely significantly higher. Okay, this one is a little scary, but the NASDAQ is actually tracking the behavior of the market from the 1920s, not the 1990s. FYI. One of the reasons why our economy grew in the 20s, but more so the 90s, we're probably more related to the 1990s, is all this new technology enhanced productivity. And when it started happening, we didn't understand it. The Fed didn't even understand it. At the time, the head of the Fed was Alan Greenspan, and he was a data junkie. I mean, he read statistics like no other person I've ever seen at the Fed. Okay, I know this is a little bizarre, but he even tracked the sales of men's underwear. And that was a primary indicator of if we're going to go into a recession. If the sale of male underwear started going down, his recession radar went up. So when I tell you he was a data junkie, he was a data junkie. So Greenspan started saying in his speeches, he thought something was happening with productivity, that with all this new technology, it was altering the economy and improving productivity. Improving productivity lowers inflation, and it grows your economy. Now, who was president back in that period? In the mid-late 1990s, it was Clinton. The CBOE that forecasts what our deficit is going to be was still forecasting a deficit, but under Clinton, we went to a surplus. Why would we go to surplus? Because we had productivity gains and our economy grew in ways that nobody forecasted. AI is supposed to be more powerful than the technology that we developed in the 1990s. So how is it not going to add to productivity? How is it not going to add to growth? So we think that productivity will be a very important factor in our markets. That's just a chart of the S&P showing the secular trends. Obviously, red going up is bullish. Lines going straight. Secular bear markets trade sideways. Now, I don't want to scare you because what I'm implying is that we're going to have this great bull run and then we're going to crash. And then we're going to be in a secular bear market for 15 to 20 years. But it's not to panic. You can make money in a bear market. You just have to know where to go. So let's go back to the 90s. What happened? So internet crashed, right? Markets went down 50%. NASDAQ went down more, but the S&P went down 50%. But what went up? Energy stocks went up. Commodity stocks went up. Large cap stocks went down. Small caps went up. Emerging markets went up. So you get a leadership change. So it's not that you can't make money in the market. You have to know where to reallocate the portfolio. So I think you can make money, but the problem is markets trade sideways in a bear market. The downs tend to be bigger. They tend to be 50%. You will rally up back to that old high. You could possibly even make a new high, and then you go back down again, and sometimes you can go down another 50%. They're awful in terms of emotions, but markets that if you stay focused and patient, you can actually make money. And I think in the next bear market, you'll be able to generate income. I think that's going to be an income-generating market. But, oh, this is what I wanted to show you. Oh, you really can't see this. You see, yeah, you see this red line? You see how the market went vertical right there? That was 1995. That's the peak in 2000. Hold on, go over here. This is 1995. See how we went vertical? And then we peaked out. I think we just started, I think we're right here. I think we're in inning like 2, maybe 3. This is very, very early in the cycle. A lot of people will tell you that we're already in a bubble. I think we're just starting a bubble. This is just looking at earnings. Earnings continue to grow. That also gives me a positive loop. Everybody keeps talking about profit margins. Are they going to expand or not? Well, the simple math is take profit margins for the S&P 500, do year-to-year change. Are they growing or are they not growing? They're growing. You add on all this new AI, and by the way, I don't know if you're paying attention to the CEO comments coming out of Davos. They're all raving about the productivity enhancements that they're already seeing, that they're extraordinary. I mean, CEOs don't use big words, especially of public companies, very easily. Because they have to be accountable. But the language that you're hearing out of these CEOs is language I have never heard in my entire career. So we're going to continue to see profit margins expand. I was just talking to a kid in the Bowie house. I think live example. I like to talk to people to see what's going on. So I'm talking to a young kid out of college. Great school here in Texas. Great GPA, can't find a job. By the way, this I hear a lot. A lot of young people, very well educated, are not finding jobs. That's because we're at full employment. Understand we're fully employed, and this is what happens when you have full employment. But we get talking about Bitcoin, and we started talking about ChatGPT. He's like, I use it all the time. I said, talk to me more, because I'm not really a good user yet of ChatGPT. He said, Marianne, he said, the more you put in and the more precise you are, you get all this information. So this is the one example that I loved. He said, you can actually put into ChatGPT, I have these ingredients in my refrigerator. They're about to go bad. What can I make with these ingredients in 20 minutes? And you'll get step-by-step instructions of how and what to make, including do this, turn your oven on, go back and do this. I went, really? He said, yes. And then if, let's say you're trying to write a letter, it'll write the letter, but it's too businesslike. You need it more friendly. Just say a little bit more friendly. It'll rewrite the whole thing in seconds. So the younger people, see what I'm paying attention to, the younger people are using it. He says, Marianne, I use it every day. So then my next question was, do you use the free one or do you pay for it? He's like, I use it so much they made me pay for it. So you can use it so much for free, but if you really start using it, they make you pay. So younger people are on ChatGPT. And here, I think we're doing productivity very much like the 1990s. We've already had a big surge. We're rolling over. I think we're going to get another big surge up in productivity. Corporate profits are expanding. Oh, I'm doing this. This is a really weird flicker. I have to do the opposite if I want what I want to do. So if I want to go forwards, I have to go down. It's weird. So the naysayers say, well, the markets really can't go up that much because they're expensive. That's the truth. They are expensive. This chart goes back to the 1900s, and this is doing a PE ratio for the S&P 500. If you don't know what a PE is, you take your stock price or your index and divide it by earnings. And it's a way to measure the valuation. We are near historic valuations, even going back to 1900. But what I learned, I did the log of the PE. It's a nice little math trick. And I noticed when you're in a secular bull market, PE multiples expand. So if my thesis is correct, not only will PEs stay high, they're going to go higher and possibly in the future surpass the highs of 2000. And what's going to happen is nobody's going to like the market. They're going to be skeptics, right? Naysayers. All I need to keep the markets going higher. It's not until everybody throws in the towel that markets actually finally peak. So I'm not really concerned about valuation. The other reason why I'm not concerned about valuation, everybody keeps talking about the Mag 7. Have you heard about the Magnificent Seven? So these are 7 companies. They're tech-related companies. They're the Apples, right? The Amazons of the world. Who had the best earnings last year? Out of the S&P 500, out of all the 500 companies, who had the best earnings? Mag 7 did. So they're not just going up with no earnings. They're going up with the strongest earnings, the strongest growth. So their valuation's a little bit higher. That's okay. Everybody's concerned the market is concentrated. We actually have less stocks in the market than we've ever had. Right, when I came in the market, at least and I'm not talking NASDAQ, this would be New York Stock Exchange, there were over 5,000 listed stocks. That's down to about 2,400 stocks. And a lot of companies that are in the private market are just not coming public, so the supply and demand dynamics are off. What else is positive? Well, if you look at the Magnificent Seven, what's their balance sheet look like? Balance sheets are important. How much cash do they have? Some of these companies are sitting on $50 billion of cash or more. Microsoft said it's going to invest $80 billion. That's a lot of CapEx spent. So the Magnificent Seven are magnificent. Now, there used to be an acronym called FANG, and I understand why they went from FANG to Magnificent Seven. First of all, it sounds better, but it has less companies. But if you add in the other FANG stocks, all those tech, and why do I say tech related? Because we removed what we used to think of tech stocks into different sectors. So Tesla is a consumer discretionary stock, but it's really a technology stock. Amazon is a consumer discretionary company, but really is a tech stock. They have cloud. Amazon's a cloud company. Should be in tech, it's not. Because they have this whole retail, so they put in consumer discretionary. And they have retail and they have food, groceries. You have Google, Meta, Netflix, all in consumer services. By the way, the best performing sector last year was not technology. It was consumer services. Then technology. But if I take consumer discretionary, consumer services, and tech, and I take all those big companies, they were the best performing with the best earnings. What's wrong with that picture? And are their earnings going to go down? Have you seen the announcements that have come out since Trump has become president? Do you see the money that he is going? Did you hear about Stargate? I love that name. Well, that's because I'm a sci-fi person. I went, yes. Right? Another thing that I wrote in my year ahead, and I'm not trying to pat myself on the back, this is easy stuff. Where are the companies that are creating the innovation? This is not hard. Where's Apple? Where's Microsoft? Where's Amazon? Where's Google? What country are they in? US. All of this stuff is coming out of the United States. We're the envy of every country in the world. There's a handful of stocks, I could probably count on one hand, that are overseas. One of them's Taiwan Semi. But guess what? They're building plants here in the United States to manufacture chips. In fact, they've already started to open one in Arizona. It's not fully operational, but they started. You want to be in innovation, you're here. You want capital, you have to come here. Venture capital's here. There's no other country in the world that has VC. Actually, I have to take that back. France does now. France has finally woken up and does have somewhat of a VC market. But most of the VC is all here in the United States. We're funding this. So if the companies are here and we're funding it, where do you think people are going to want to put their money? This country? Why do you think Saudi Arabia wants to put money here? Why do you think Abu Dhabi wants to put money here? Why do you think Japan, SoftBank, wants to put money here? They want to be where the action is. Right? Trump inherited this, but he understands the position that we're in. And what came into my head, he's going to springboard this. If they're going to throw billions of dollars into this, what's going to happen to our economy? It's going to go up. What's going to happen to corporate earnings? It's going to go up. What's going to happen to the stock market? It's going to go up. Is this really hard? When you lay it out in simple terms. Now, can we have setbacks? Yeah, my aunt always told me I had to have a window. I needed an exit strategy. Marianne, where will you be wrong? Well, what happens if inflation comes back? What's the Fed have to do? They have to raise interest rates. That's a game changer. Then we're in a bear market. Then stocks are going to go down 20%. I would be outright wrong. I think we're okay with inflation. I think we're stable to slightly down. Will the Fed cut anymore? Not in the near term. Trump may put pressure on them. I don't think they're going to do it right away. Maybe later in the year they might. I think it was insane that they've already cut 100 basis points because it's like putting gasoline on a fire. This is what's going to fuel a whole bubble in the market. So I don't think we need it, but they may be pressured at some point in time to do it. Right? They did it because they thought there was weakness in the job market, and we haven't really had any substantial weakness in the job market. I talked return on equity. This is important. So if you listen to Warren Buffett, or if you've ever listened to Warren Buffett, one of the factors that he looks at is return on equity. You want to make money on your investment, don't you? One of the ways to find that is by looking at this thing called return on equity. Well, guess where the highest, for short we call it ROE, guess where the highest ROEs are in the market? In tech and tech-related. The S&P is 18, and tech-related is 30%. No wonder people want to be invested in them, right? Every time I turn, I come there. It's just they just have superior performance. Yep. So remember I said you have to be all in? Part of the hallmarks of a market getting in danger is not only everybody's all in and you have euphoria, but they leverage in. Now everybody's happy, so they want to take the risk, and they're going to borrow money. So for the market, one of the ways we look at that is New York Stock Exchange debt. And it actually is coincident with market behavior. As debt goes up, markets go up. But to understand if we're at an extreme, I normalize the data. If you're not really big into math, think of it as like standard deviation, but I do something that's called a z-score. But it's a normalization. And I did it over a 5-year period. They're not even close to being levered in the market. There's a long way to go to add leverage in this market. And we have a mountain of cash. Every month I go to look, we're putting more and more. Why? Because the investor wants that 4 or 5%. And we still have skepticism. There was concern about Trump being president, right? So people piled into cash. That cash has to go down by more than 50%. So let's say $3 or $4 trillion has to go into the stock market before this is over. What's that going to do to stock prices? Right? It's a lot of money. I've talked about this, household net worth, record all-time high. I asked Brad at lunch today. I said, Brad, when household net worth is up, when the investment count is up and your client's house is up, I said, how many are calling asking how much I can spend? And Brad, what was your answer?
They don't ask, they tell me.
There you go. We spend money. The consumer's fine. there is a pocket of the consumer that's not fine, right? This is important because the consumer is a very, very integral part of the economy because we spend so much. The middle to upper class have absolutely no problem with spending. They're not heavily in debt, and their net worth keeps going up. A happy consumer spends, and consumers are becoming happier. Under the Biden administration, not a lot of happiness. Inflation, 9%, not a lot of happiness. Inflation coming down, change in administration, the consumer confidence is coming back, business confidence is coming back because Trump is expected to have a deregulated type of environment. CEOs at Davos are giddy over themselves that M&A is going to come back. IPOs are going to come back. Now, M&As can be a signal of a top, but that's when you do really big companies merge and they do it with a lot of debt. We haven't even started an M&A cycle yet. Haven't even really started an IPO cycle yet. We're in that early stage. That's why I said, I think we're in this sweet spot. Talk about the sweet spot. I know this is going to sound really weird. This is something Aunt Bernadette taught me, and basically it's getting lost. Only the older generation really talked about this. There was a gentleman in 1939 that believed in cycles and studied cycles. And he sat down one day and said, we should have a 10-year cycle based on all the cycle work he's doing. So based on 1939 and going back, he looked at every year of the stock market and looked at the return, and then looked and did an average and found that there was a cycle. And we've carried this from 1939 to today, and there is a cycle of behavior of how markets perform. By the way, zeros are really bad. Think about 2000, right? Think about 1990. Do you remember what happened in 1990? Saddam Hussein invaded Kuwait, oil prices went up, stocks crashed. We came back, but zero's not so good. But guess what? 5 is the best part, the middle of the decade. You're up 19%. And then based on all the stuff I keep telling you, I feel like it's the sweet spot. Oh, and here's another thing. The first year of a president is the best year. Now, I know it's not Trump's first year, but we only have one other president that had a consecutive term broken up. So many of us are categorizing this as Trump's first year. Well, in the first year of a president, markets are up 20% on average, 9 out of 10 times. When Trump came in 2017, markets were up. We didn't have a bear market till 18. Trump wants a good report card his first year. He'll take a bear market maybe next year, but he's not going to take a bear market this year. Now, he was at Davos speaking on the big screen. What does he want Saudi Arabia to do? Build up supply, take prices down. Because what is his promise to Americans? I'm going to take inflation down. So how the heck does a president of the United States take inflation down and do it fast? Get oil prices down. It's the fastest way, right? Cost of production for companies comes down. It's a tax cut for consumer. The consumer has more money. So if he can get oil prices down, that's actually very bullish. So I think when I line everything up, I just don't see how we get a bad year. Now, can Trump say something one day and have markets move? Of course he can. We all know that. But markets were relieved when he didn't do 60% tariffs or he didn't implement tariffs right away. Did you really think he was going to? Don't we know him by now? He's a tough negotiator. And he does scare tactics. Now, look at TikTok. This is genius, by the way. Trump was told by the CEO of TikTok, if Americans are on TikTok, my company's worth $1 trillion. If I don't have Americans on TikTok, my company is worth 0. You think he has a bargaining chip? It also sends a message to China that he's willing to negotiate. He'll give them the chance to negotiate. Volatility last year was actually pretty bad. We had 5 corrections last year. My theme last year was called the bucking bull. The bull bucked. It bucked coming into this year. We still may have a little bit of the bucking bull, but a good bull rider, if they fall off, what do? They're right back up again. So if the market goes down, we're going to get right back up again. I don't think we're in any major danger. This is really important. I got to take time with this one. There's short cycles, there's long cycles. I believe we've already started an inflationary cycle. We had a deflationary cycle from 1980 to 2020. Interest rates came down to 0. Inflation, we had deflation. I think now that's completely done and ended. And we're in the early stages of an inflationary cycle. When I looked at this chart, the last time we were at 9% was in the 1950s, year to year. And we came down, we actually went negative. And then we started a long-term trend up in inflation. When I look at interest rates, I believe we've made a generational low and that we will trend up. Now, interest rate cycles are longer. They normally last 20 or 30 years. The last interest rate cycle was 40 years, from 80 to 2020. So I see interest rates going up over time. You'll see 10% interest rates again, but maybe not for 10 years. But we're in a whole new paradigm. Onshoring, reshoring, is that inflationary or deflationary? It's inflationary. Taking cost of production from overseas back here is actually an inflationary event. I think the next cycle is going to be a commodity-driven cycle because of inflation. Real estate will do well. We still have a shortage, so real assets will do well in the next cycle, right? So I think right now we're in the sweet spot where inflation is coming down, rates can come down, and then we're going to bottom and we're going to slowly creep up. But having a 10-year anywhere between 5 or 6% relative to history is normal. We can operate an economy in a 5-6% interest rate environment. It's when you start going above 6%, 7, 8, 9, that you start getting ripple effects. Now think about what's happening in Southern California. Now, it's tragic, but now I got to look at it from an economic standpoint. Newsom thinks he can clean up the place in a year. You think that they're still burning fires? They're not cleaning that up in a year. But let's be optimistic and say it's a year. Then they've got to build. This is going to be one of the massive infrastructure builds. Forget it. We still have to build for AI. We still need more electricity. We still need to fix our infrastructure around the country, okay? Just that. But now think about California and what's burned. And the way I can do it in my brain, because I'm from New York, it's more than 2 Manhattans. And I don't even know if we're going for a third with the fires that are happening right now. Could you imagine having no Manhattan? And no 2 Manhattans? That, into my mind, like explodes. Now, try to build Manhattan in a year, 2 years. This is going to take a long time. And where are you going to get all these materials at one time? The cost of materials at some point. So I think back out in the decade, commodities are going to go up. And that's going to be inflationary. You have to remember, all this money we printed, yes, it's going to go into the stock market, but it's also inflationary. Now, for people that are retired, this is going to be brilliant. Perfect timing, because you're going to be able to get dividends in the fixed income market. You just got to shorten up your maturity and just keep rolling them, right? So they mature, so if the rates go up, you just keep getting higher. So you'll be able to generate income income from the fixed income market, but equities are a hedge against inflation. So I'm kind of getting over my skis because I'm giving you the long-term picture. What I'm really trying to tell you is right now, between now and the end of the decade, is probably going to be one of the best times to ever invest in the stock market. And if I'm right, portfolios can double from here, depending on what you're invested in. that if you can actually invest in all of this AI stuff, you're going to see net worth in this country go through the roof. Now, another thing I want you to think about, the inauguration. Who is sitting behind Trump? CEOs. Elon Musk was there, right? Apple CEO was there. The former CEO, Bezos, from Amazon. Do you know LVMH CEO from France was there? He's not getting a lot of press. You think this is going to be a business government? This is a business government, right? Very different environment. If Bessent gets gets approved to be Treasury Secretary, he's a Wall Street guy. He's a hedge fund guy. He was a global hedge fund guy. He worked for Soros. You think they want to disrupt the markets? No. And think about the dollar. Everybody thought the dollar was going to go to zero, right? It's going to fall apart. The dollar's broken out. The dollar's the strongest developed currency in the world. A couple of reasons why. Our interest rates are higher, so we attract more capital, but we're the innovation center of the world. You're going to continue to see capital come here. So if you're in euros, or if you're in Swissies, or if you're in pounds, you got to take those and convert them into US dollars. What happens to the US dollar? People worry about the deficit. I don't worry about the deficit. Why do I not worry about the deficit? Well, we've been debating deficits ever since I've been in college, and whether they're good or bad. We are the reserve currency of the world. We are the innovators of the world. And as long as you have the confidence of your creditors to buy your debt, you can fund your debt. Yes, the cost of the debt may go up over time. But if Doge, you all heard about Doge, right? If Doge can find some fat and cut out some fat, that's going to be very, very good. And I'm a believer, and this is my personal bias, if Trump does create a reserve for Bitcoin, I think over time Bitcoin can grow and can be an offset to the deficit. And I'm bullish because I think part of it is we can grow our way out of this with the innovation and productivity enhancements. So I don't think the deficit is a major problem for this country. That doesn't mean you're not going to hear about it. Doesn't mean people are not going to talk about it. Doesn't mean that bond vigilantes won't show up in the bond market occasionally. But I don't think it's going to wind up materializing into something very, very significant. Crude oil is at risk of breaking down now. I mean, depending on where we go. I've been pretty much saying that crude can be stable, but if they really want crude oil prices down, it actually can break down and can be around 50 bucks. That's just not good for energy, big oil companies. So I'm not really bullish on big oil, but if you look at LNG, and particularly if you look at pipelines and natural gas, that's what's working in energy. So energy is kind of split between the big integrateds and what's happening in the gas part, and that includes MLPs. MLPs are also doing really well. Nice dividend yields. The 2-year Treasury yield looks like it's trying to come down. That's with the Fed lowering rates. If the Fed over time can lower rates, we'll see the short end of the curve come down a little bit more. But I think the back end of the curve is going to have, if we're growing at 3%, and I think there could be risk in time that we have a quarter of GDP growth that could be in the 4 or 5% range. And if that happens, the risk is that 10-year Treasury yields back up to 5%. The day that Treasury yields hit up to 5%, we could have a 10% correction in the market, but I think it's just a temporary pullback until we can adjust to the environment at 5%. But we've had bull markets with 5 and 6%. I don't think it stops a bull run. The dollar's already broken out. Nobody talks about this. The dollar's already in a bull market that nobody wants to talk about. And if capital keeps coming here and our interest rates stay high, we don't have a currency problem. And money's already coming in this country. It's coming in loads, and now we're getting even more. And because I think we have inflation, I think gold has sniffed it out. We've had a massive breakout in gold. Now, I think gold is also being used because they're concerned about the deficit. They're concerned about the dollar going to zero. I think this is a sign that the market has sniffed out inflation. And I think the long-term target on gold is 4,000. That's almost a double from here. Silver's trying to break out, but gold is really the leader in the metals. Come on. I'm not a big fan of small caps, but I do think they can pop up in here temporarily. There's also something that's called mid cap. But when I really dissect the market, I think over time it's going to stay what we call mega cap. But I think in the very near term, you're going to see some good action in small cap. Why is that important to me? I want to see the market broaden out. I don't want to just see the Magnificent Seven. We want to see more stocks participate. It means the market is healthy. And it's a cyclical market. This tells me the cyclical stocks are doing better than the defensive stocks. That tells me the economy is going to stay strong, or the market is believing the economy will stay strong. And this is FANG. It's in a bull market. On the bottom, the most important part here is the bottom. This is the FANG stocks, which are tech and tech-related stocks, all the important ones, relative to the S&P. Meaning if that line is going up, they're beating the S&P. That line is going down, they're underperforming. This line is going up. Technology is the clear leader. That's the best performing. The tech sector overall is just a massive leader. The semiconductors have been the major leaders. They're going to stay leaders. NVIDIA is going to stay a leader. But there's cycles in technology that I learned very early in my career. You enhance your chip, you enhance your hardware, then you go through a software cycle. I think we're moving into you didn't hear a lot about software. Now you heard about software. Stargate, Oracle, software company. Palantir, cybersecurity. This is all software. So I think software is going to play a really, really big role. Software is just emerging as leadership. So my favorite stock, but it's going to be a lot more volatile, is Palantir. That's one of the go-go software stocks, one of the newer ones. What's also important to your economy is your banks, right? If you have a business, you need a bank. You need help with your payroll. You need help with your inventory. If a bank is willing to give you credit lines and give you loans, you can grow your business. If you can't get those credit lines and loans, your business contracts. The Fed was looking at instituting more capital restrictions on banks that were called Basel III Endgame. That's being dialed back. Banks now can be more profitable because the yield curve is more normalized, with short rates are lower than long rates. That helps what's called their net interest margins. They're going to have deregulation. They're going to have more activity, more investment bank, more IPOs. So the major banks just reported blowout numbers, huge numbers, and are forecasting continued significant growth. So if your banks are operating, then your economy's operating, your business are operating, your business operates, my stock market goes up. You see how I keep connecting the dots? I can't find a negative. I keep trying. I can't find one. So, I'm wrong way. And then there's Bitcoin. Bitcoin has just broken out to new highs. Ethereum has not broken out to new highs. Solana has broken out to new highs. So what is all this thing with Bitcoin? I talked a little bit about it. When I first looked at Bitcoin, it was at $200. And I go by my instincts. I get these feelings, these vibes. I really call it divine inspiration. And I felt like this was symbolic of the world going digital, right? Because I'm a sci-fi person. I'm like, this is going to be part of this digital era thing. The stupid thing I did is I never bought it at 200. I own it now, but I didn't buy it at 200. Should have. But I do think it's symbolic that this is the internet cash. It's a store of value. I understand it's air pudding and wind sauce. Think about that. Air pudding and wind sauce. Sounds great. Can't touch it. You can't feel it. I get that you can't touch and feel it. But show me a young person that has a problem with digital. This is about the younger generation. Sorry, guys, it's not about us, right? This is a movement. And understand the Chinese government tried to shut this down. The US government has tried to shut this down. They have not been able to shut this down. And now Trump is bullish crypto. He has his own meme coin. His wife now has her own meme coin, and he wants to invest in the infrastructure. So it's going to happen. And the psychology of it is going to be bullish. But again, most volatile asset I've ever seen. But remember, Bitcoin is digital cash. Everything else is technology. So Ethereum is, think of it like the Microsoft on the blockchain, right? Building a platform for programmers to build on. But now they have a competitor called Solana, trying to build out a program that they say is faster, better, and cheaper to work on. And Trump issued his meme coin on the Solana exchange, not the Ethereum exchange. So there's intense competition. So this is where we can go back to the early stages of the internet, right? We had all these companies, they were high-flying, and only a handful survived. We're in that early stage. We don't know who the winners and the losers are, but we're fairly confident that Bitcoin's going to be around here for a period of time. That's not going away. And with that, I'm happy to take questions. Sorry that was so long, but that was a lot of information that I thought it was really important. Any questions? Don't be shy. Somebody has a question, I know it. Yes?
You indicated that the PE ratio that we normally would see is going to get larger.
Correct.
For example, and this is not educational type numbers, but I think of the banks as being 11 to 12 in a PE ratio. And now you've got Wells Fargo up over 14. What's the percentage of growth at that new PE ratio that we've got to get used to?
You know, that's a really good question. And you have to do it by industry. You have to do it by their earnings power. So when you look at the big tech companies, they're trading high 20s, 30s, right? But extraordinary, like a company like NVIDIA grew their earnings 100%. NVIDIA is now cheaper than it was a year ago because of the growth in their earnings. That's a very specific company. But if the growth in revenues and earnings stay very, very strong, then the PE in the tech companies are going to be in the 30s, let's say. High new growth companies are trading in the hundreds still. And think about Amazon. When was the last time Amazon was cheap? Anybody know about Amazon's PE? Now, I'm being very precise. I remember when I liked Amazon, it was 300 PE. I remember when it was a 200 PE. Now it's a 30 PE. Did you not want to own Amazon? But the whole key to Amazon is they went into the cloud. Their big business was cloud. And that's why the stock kept going up. Banks now are totally different. Banks are never going to have the growth rate that tech companies have. But what people like about the banks is that they can now grow their earnings faster, right? Because they're not going to have the capital restrictions, additional capital restrictions, and their net interest margins can go up. Most bank stocks don't trade on a PE, they trade on price to book. So if you looked at Jamie Dimon's bank, JP Morgan, most people based on valuation would sell it. In fact, some analysts have already told people that they've downgraded it. It's the most expensive stock, but it's the crown jewel. But if you look at like a Citibank or a Bank of America, they're just above tangible book. So they can still double book. And I just happen to know that. I'm not an expert on every industry and every group. So you have to say, where's the earnings power going to come from? And when we look at where the analysts are raising their numbers across the market, the strongest earnings power growth is coming from tech. But people are concerned because tech has the highest PE multiple, and the market's at the highest multiple. I mean, I went back to 1990. Most people don't go back to 19. We're up there in the stratosphere of valuation. But you can have higher valuation in a lower interest rate environment. We just lowered interest rates so you can carry a higher multiple. But I'm also forecasting that the market's moving into a bubble, and eventually valuation will not matter. Now, PE multiples, you can't time the market. There's no way. It's just, it's a point in time. But every time the market gets cheap, it's a buy. But even if you go back to 2008 and 2009, we never went to a single PE multiple. Everybody was waiting for the S&P to get to single digits, but the banks got bailed out. So we never went down to single digits. So that is, it's tough. It's just a statement. So what I'm willing to do is, based on all the evidence that I have, is I'm okay with an expensive market. Now, can we have pullbacks and corrections? What I'm basically trying to tell you is we're not going to get a cheap market. You're not going to get a cheap market until 2029 or 2030 is what I think is going to happen. It's just not going to get cheap. But you may see, even if I look at healthcare, so what don't I like? Healthcare. Healthcare looks like it's an intensive care unit, not even ready to get out. Now, if I look at the index, it's going up. But when I look at the performance of healthcare stocks relative to the market, it's a nose. It looks like it's headed to zero, right? Because their growth rate is slowing. The products that they have, their growth rate is slowing, even for GLP-1s, and they don't have a lot of stuff in the pipeline. So I think their PE multiples are going to continue to contract. You might have some, companies that do okay, but the sector itself looks disastrous. Consumer staple stocks, those are Kellogg, Procter & Gamble, Johnson & Johnson, things that you have to buy. They're expensive. Alcohol, new statistic. Alcohol consumption's going down. Oh, this is a great statistic I saw today. Nobody comment on this because you're going to incriminate yourself. But they showed age groups of alcohol consumption and marijuana use. Believe it or not, the biggest increase in age group for marijuana is 55 and older. It was really funny, from Bloomberg. People are switching from alcohol to marijuana, right? So alcohol companies have problems, right? So they're trying to diversify and figure out what they're doing. That's in consumer staples. So I don't like that sector. Utilities, those that have nuclear are on fire. The stock prices already are up. Constellation stock this year to date, we're 3 weeks in, is up 50%, and Vistra is up 35%. This is a utility company. But the rest of the utility companies are subject to this volatility at the back end of the yield curve, and they're not up so much. But over time, I think there's pockets where you can own in utilities. Real estate will struggle if mortgage rates don't come down. But rents are doing really, really well. So even with all the supply that's coming on the markets, rents aren't coming down. So I think housing is a great place to be. You got a lot more in your answer. I'm sorry. You're welcome. Any other questions? I know it's been a while. Was this helpful, hopefully? Did you understand it? That's important, right? This is very understandable, isn't it? You just got to line up the little pieces and put the puzzle together. Well, then I want to thank you so much for having me back, and I will be your adopted cowgirl here down in Texas, in Fort Worth. Thank you very much.